Ticker symbol SBUX has been having a rough year as its stock has returned just under negative 28% for the past year. And today, we'll be looking at a clear market leader which has a very wide moat in my opinion, and which could be the perfect dividend play because it has very solid fundamentals, very stable and improving efficiency ratios, and it is currently trading at a 2.5% dividend yield at a very attractive valuation. So let's take a deep dive at StarBucks, a specialty coffee company. Now in their annual report, they say that they're a premier roaster, marketer, and retailer of specialty coffee in the world, operating in more than 86 markets. So basically, their operations consist of purchasing, roasting, and selling coffee, tea and other beverages, and food items through their stores, which are not franchises, but instead are owned and operated by them. Now, the reason why the stock is down so much, which has actually traded down by around 20% this past week, is because earnings disappointed and came below estimates, and they actually experienced a decline in sales for about 4% this quarter, which is very negative. And even though investors were expecting a bit of a slowdown, they weren't expecting such a big pullback in revenue, which has caused the company to become very discounted in the stock price. StarBucks currently has a growth strategy which can be divided into 4 different pillars. The first one being for them to expand the global store base in both developed economies and growth markets for them, which may be China or even India, where right now there isn't a Starbucks in every single corner as there is, for example, in the US, and there is a lot of more people that they could serve and actually sell their coffee to. The second one is to optimize the mix of company-operated and licensed stores globally. So I believe that apart from the company-operated stores, they also license some and do sort of a franchisee treaty, and they want to balance and optimize the mix of these 2 types of stores in order to improve the margins as Starbucks company. Number 3 is to drive beverage and process innovation in their leading digital platform. And finally, they want to offer consumers new coffee and other products across new categories, diverse channels, and even alternative store formats. But if you don't drink coffee, this company gets even more interesting when you break them down into numbers, because for a coffee shop, they have a return on capital employed of 18%, which is incredible. Then they operate with an interest coverage ratio of 9.6 times, which, although it is not 10, which is the threshold that we usually look for in this channel, a 9.6 is pretty solid. This means that with their current net income, they can pay over 9.6 times their yearly interest payments. And this is very solid as it means that even if they have a very bad year, such as COVID, and their revenues decrease by around 70%, they still have enough net income to pay back their interest, which gives you a lot of stability as the investor. Then, they have a cash conversion rate of around 113%, which means that for every $1 they get in net income, they create $1.13 of free cash flow. Then, although they have low profit margins of 22%, their net margin of 15% compensates, and it's just around the threshold we would expect for a company like Starbucks. Now, when we look at their revenue growth, it has been growing every single quarter for the past 2 years. Now, if we look at the past quarter, we can see that Starbucks operating income is actually down 4.2% quarter over quarter, and their net income is actually down 3.2% since the previous quarter. Now, in terms of debt, this is the main red flag that I have seen with Starbucks, and it's the fact that they have a lot more liabilities than total assets, and they have been doing so since 2019. Now, we can see that they haven't been making clear efforts of increasing their current ratio to make themselves healthier. However, they're trading at a current ratio of 0.8, which is nothing too bad. However, I do like my companies to have a current ratio of above 1.2. And now, this of course generates negative equity for the company, which to me is always a negative sign for a company. When they have negative equity, I do tend to stay away from them and conduct a deeper dive into the company, since this usually means bad news. Now, in terms of their efficiency ratios, they have been extremely stable. They fell a little bit in the last quarter due to the worsened metrics. However, their return on invested capital right now is sitting at above 15%, which is very solid, and it has been trading there for the past 3 years. Now, in terms of their fundamental analysis, I gave this incredible company a 5 out of 8, and we will see why. First, of course, they have very low liability risk, and we saw this with the interest coverage ratio. That's why they get a tick. then they are very consistent with their cash flows. And this is very positive since it means that the company is predictable. Of course, this company pays a very good dividend, which has been increasing for a very long time, and they offer share buyback programs, which is very good for the investor. And of course, this is one of the companies which has a lot of pricing power and is able to exercise it. And this is beautiful the way Starbucks does it. And why do they have this much pricing power? Well, this is because of their current existing moat and existing competitive advantage. Whenever you're doing tourism or just in your own town and you want some coffee, the main brand that's gonna pop into your mind, unless you are a diehard fan of local small coffee shops, is a Starbucks. And why is this? Well, it's because of their product. And of course, their top of the class service. But why? Well, because they're extremely consistent. It doesn't matter if you're going to Starbucks in the US, if you're going to Starbucks in Spain, in South Africa, or in Australia, everything is going to taste and work extremely similar. You know you have a very friendly environment, you know they're going to treat you well, you know what you're getting is very good. However, one complaint that I do have, I will still go to a Starbucks if I don't know any other place, although I know I'm getting ripped off and buying a coffee for a lot higher price than if I went to the local store. Now, 3 things that I did not like about the fundamental analysis is, first of all, the solid balance sheet. Well, mainly because they have negative equity, and we already spoke about this. But again, I have seen that in this quarter, they are actually struggling to grow their revenue organically. And of course, this means that they're struggling to grow their free cash flow organically. However, I will follow Starbucks in the next earnings to see if they're able to improve these metrics and actually start growing their revenue and their free cash flow again. Now, in terms of dividends, this company is beautiful. Just look at the dividend per share increasing at a very fast pace every single quarter. And the beautiful thing is here that you can see that the amount paid is actually not increasing that much. The dividend per share is increasing at a way faster rate. And this, of course, can only mean one thing, that they're conducting very aggressive share buybacks. Now, one worrying thing that I see here is that they currently have a payout ratio of 60%, and this is reaching the limit of when it actually starts to get worrying. Right now, it looks like the dividend is safe. However, I like my payout ratios to be a lot smaller. Now, Starbucks is trading very attractively in terms of a historic PE ratio, and of course also at an attractive valuation when seeing that their free cash flow yield is 4.4% versus the long-term inflation rate of 3%. However, this may be because of the risk and possible challenges. Now here, the main ones I see is, first of all, the worsening competitive landscape with, for example, McDonald's creating a new franchise which is supposed to be competing against Starbucks, and as Joseph Carlson calls it, the caffeine bubble, with so many players actually getting into this space. However, of course, we know that Starbucks is the leader here. However, they will have to try and retain their crown and keep gaining market share, which they have been struggling to do so in the recent time frame. Now, in terms of regulation and performance, these do not scare me at all, but in terms of the market, I do have this worry with Starbucks, where if there is an economic downturn, I believe that Starbucks is one of the main things that consumers will start cutting down when they get into financial trouble. Before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that Starbucks has one of the greatest moats in all of the stock market. It is able to produce consistent cash flows and it has very high return on capital employed, meaning that it can create value for the investor. Now, I believe that this is a very good company and that it will probably be a very good investment. However, their weak balance sheet and their uncertainty with their growth rates is actually making me stand in the sidelines instead of actually buying this company right now. So thank you for watching. As always, this has been the Cashflow Compounder. You can join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.